Hi guys, I wanted to post a video this morning in regards to a market change that occurred that's very important to what we've been talking about and studying. You know from the international section that foreign exchange rates fluctuate regularly, and the dollar is a major foreign exchange currency, meaning that many people all over the world want to hold dollars. Well, there is an index that is often used to track the value of the dollar compared to a variety of major foreign exchange currencies, such as the euro, the yen, and others. This index is called the DXY, or Dollar Exchange Index. And we can track how this index changes over time. Well, what happened today, this is the one-day chart here, is actually, no, that's not the one day. Let me go ahead and, there we go. What happened today is the dollar started the day at an index of 94.8, almost 95, and dropped down to 93. Now, that is a significant drop in just a matter of hours since the market's open. You can also see this in the context of a longer time frame. If we go back a week, it's been dropping. If we go back a month, it's been dropping. 3 months, it's been dropping. 6 months. Now, we see a low here back in March, but you really have to go back to 2018 to see an index lower than what we hit today. Okay. Now, what does this mean? Well, when the value of the dollar drops, it makes the goods that we produce cheaper for foreigners to buy, and it makes the goods that we buy from foreigners more expensive. So on the one hand, a lower dollar value will stimulate our manufacturing sector because the goods that we produce here will be cheaper for foreigners to buy if the dollar is lower in value. But everything that we buy from other countries will be more expensive, which can put pressure on inflation. Because remember, a lot of consumer goods are produced in other countries, like China, for example, and Japan, and some others. And so when the dollar drops, those goods become more expensive. Okay, just look at a lot of the stuff that you've bought in the past year and ask yourself how much of that stuff was produced in another country. Well, if the dollar loses value, then that good goes up in price. The other factor is we import from other countries a lot of raw materials. So when the dollar loses value, it becomes more expensive for domestic producers to get the ingredients to make the good, which usually makes the cost of production higher and raises the price of the product. So a lower dollar value, let's go back to the one day, is often correlated with eventual inflation. Now, there are some markets that respond very quickly to a lower dollar value, and those are markets that involve commodities. Commodities are important goods, and they're often traded across the world, and they're often traded in the US dollar. So, for example, if Brazil wants to buy gold from Saudi Arabia, they will do that transaction in dollars. Similarly, if Brazil wanted to buy oil from Saudi Arabia, they would do that in US dollars, meaning that these commodities, gold and oil, are going to be very responsive to changes in the value of the dollar. Let's see what happened today. Well, if we look at the price of gold, it hit a record today. This is from the Wall Street Journal article this morning. And so let's go to the Trading Economics site to get more detail. It looks like the highest value today was about 1944, somewhere around there. But if we go back, let's go back 5 years. Well, this is the highest value. Let's go back 25 years. Highest value. 50 years. Highest value. In other words, this today is the highest value gold has ever held in dollar terms. And it's no coincidence that this is because the value of the dollar dropped. Again, when the value of the dollar drops, these commodities like gold and oil that are traded internationally will trade for larger amounts of dollars. So why is this happening? Well, one reason the dollar may have lost value is because confidence in the future U.S. economy is going down. The combination of a resurgence of COVID, especially relative to many other countries, and the uncertainty surrounding the upcoming elections, political uncertainty, makes the future U.S. economy much less predictable and therefore a higher risk. So people aren't as likely to hold the currency in the U.S. economy. They might be more comfortable holding other currencies, maybe the euro or the yen or the South Korean won as alternatives to dollars. So that will cause the dollar to drop. And that's likely a factor. But another factor is the amount of stimulus that's going on. The government is expanding the money supply, and they're doing that in order to fund these programs like the unemployment compensation program and the stimulus checks that go out to all the households. And today they're talking about extending those benefits even further. And we'll see what happens with that. An expansion of the money supply, absent increase in the amount of goods produced, generally leads to a lower value of the dollar and higher prices for things, which we call inflation. Okay, so that's where we're at now. Just understand that we are not necessarily doing a bad thing with the stimulus policy, and we're not necessarily doing a good thing. It's really going to depend on who you talk to. But it does have consequences both ways. I mean, if the government decides to print more money and try to stimulate the economy, get people more income, then the value of the dollar goes down, and we run the risk of having inflation in the future. If, on the other hand, the government doesn't stimulate the economy, then the dollar will be more likely to maintain its value. We'll have less inflation, but we'll get higher unemployment, right? We'll have lower GDP. So there's this kind of juggling act between getting inflation and a lower value of the dollar versus having unemployment and higher or lower productivity. Okay? The answer to what the right amount of stimulus is not always agreed upon. But for us, we just want to know what the trade-offs are, and then you can listen to the various commentators and come to a conclusion on your own as to what policies you think are better. But there is no free lunch in economics. There are always costs. And if you just print more money, you're going to see lower value of that money. It's going to increase inflation. And you have to be prepared to accept that when you try to stimulate economic activity. All right. That's it, guys. If you have questions, let me know. Thanks.